Okay, so hello everyone. This is Guillaume, and I'm here with Nathan Burks from the Panoptic research team. This is today the Beyond the Grades Research Bites with the Panoptic team. Uh, First of all, how are you, Nathan, today?
All right, how are you?
Yeah, pretty good. Lots of meeting this morning. Finally, again, time to do some research. Which, if you meet with lawyers, it's the relaxing thing to do. So I'm glad I'm with you today. So this is the research content that we, the Panoptic team, produces. We have research bites, we have blogs, but here it's also worthwhile to have people see the researchers themselves talk about their work. In this case, this is Nathan's work about this magnificent seven gamma traps of crypto. Very catchy title. Looking forward to learn more about this. And yeah, I think I'll hand it off to Nathan to walk us through that presentation. So maybe is this a research bite that exists already, or it's going to be published as a research bite later on?
Published very soon
Okay, so you'll get the
today.
preview now.
Yes.
Preview now. You'll see the final form on Twitter and also a blog for posterity. So yes, actually, let me change this a little bit. And yeah, take it away, Nathan.
Yeah, so I'll start with what is a gamma trap, and a gamma trap, either directly through options or synthetically, is essentially a feedback loop where you're buying into highs, selling into lows. A famous example to the upside is the GME gamma squeeze of a few years ago. A very infamous example to the downside is the 1987 Black Monday crash through portfolio insurance. So I've really gone through and compiled seven gamma traps that I believe intrinsically exist within crypto and only crypto. So to kick it off, one of those gamma traps is through the largest crypto options exchange, or the largest crypto options exchange in the world. Their margining system, Deribit, is an inherent gamma trap from the standpoint the options are inverse. They have an inverse structure, meaning that they are settled and margined in the coins you're trading. So BTC settles in BTC, E settles in E, Solana settles in Solana, so on and so forth. Um, and what this does is when you get liquidated or margin called, your collateral is as volatile as the trading position itself. So it compounds losses while also giving you additional dry powder to the upside if prices are rising or your positions are rising. So that's one example of upswings or downswings being further amplified uh, by this type of property.
And
And
this is very
really,
interesting. And
oh,
just to
go
add,
ahead.
so typically options are either cash secured or physically settled.
Yeah.
Here, structurally, it's a cash secured, but you don't get cash, you get BTC or ETH, and that's kind of the
Mm.
distinction.
Yes, yes. And a lot of the time, ironically, with these gamma traps, they're meant to dampen volatility, but at the same time, they end up amplifying it or exacerbating it. So it's kind of a self-fulfilling prophecy. And Deribit, who knows, since you're trading volatility, maybe this is by design to augment volatility.
Very cool. I mean,
Uh,
Coinbase maybe now
yeah, yeah,
acquiring.
exactly.
We'll see if they keep it up on the. But I think BitMEX also had a similar um,
Yes,
risky BTC
with
risking
perps.
as the yeah for the perp. So this is not unheard of, but yes, in the options world, definitely something that's you don't see quite often.
Yes, very unique. But you mentioned Coinbase. If that acquisition goes through, they may switch to a USD margin system. So we'll see.
Amazing.
But this goes to both sides, upside and downside. This one we went over in the prior Beyond the Greeks with myself. The Uniswap price doom loop. This is similarly structured to the Deribit gamma trap. Um, but it's only to the downside in this case, meaning that okay, a Uniswap LP position is equatable to selling a perpetual put option. So if you provide liquidity, deploy liquidity, and it breaches the upper range, say in an USDC pool, it's converted to USDC, whereas to the downside, it's converted to ETH. So you have to sell off more ETH to redeploy new liquidity to a lower range. So similar conceptually to what I just mentioned with Deribit, but skewed asymmetrically to the downside. And some of these I'll be going over are asymmetrical. This is one of them.
And this is maybe when you trade on Deribit, you get liquidated. Maybe you lose all of your collateral, but you're back settled into ETH. Here, it's when maybe an LP wants to either rebalance or redeploy. They have to cover and sell maybe that risky asset. So it's still this one maybe implies some USDC base as your collateral, maybe.
Yes.
Mhm.
Yes. To the upside. So that's where the asymmetry comes into play.
Yep, amazing.
Going to the next one, doves or DeFi option vaults, which were hot commodity a few years ago. Not as much anymore, but what I've found interesting with these is that it's kind of duly predicated on an auctions process, which options market makers can front run and artificially manipulate and depress IV going into the auction. So they'll sell off IV and then subsequently buy it once the options are sold off. And the reason they can buy the options is these are almost exclusively these DOVs marketing short gamma strategies, such as a cash secured put or a covered call. And when they sell these out of the money options through their vaults, retail traders are left in the unenviable position of not only are they short OTM options, short OTM gamma, but now they've sold it at a seasonal low in IV. So as the IV begins to restabilize to normal levels, um, that OTM gamma is going to work against them. So in the case of cash secured puts, if there's a downside move, that means you're going to have to sell more to the downside to hedge. In the case of covered calls, sell more to the upside to hedge. So this is a more symmetrical gamma trap, but the added supplement or kerosene on the fire, if you will, is that seasonally depressed IV.
And here we see some changes. Is this like in percent, or we see it goes up and down in a way that is
Yes.
following?
Well, it's really just about the timing. Like you see that large dip because most of these auctions take place on Friday. So
Oops.
the these market makers are very much attuned to that timing for the vault, timing
Interesting.
it up, and then you see how it quickly stabilizes afterwards.
So the DOV were on chain, I guess, traded, but there was still an off chain slash exchange component.
Yes,
And
component to it to make the vaults function
I'm not sure if
smoothly.
the DOV holders were hedging their positions, but at least that could have contributed to
Who
some.
knows? But that's a good point. And also to that point, you could say, okay, well, the option market makers are long gap. So that could feed more stability into that system. That actually goes into the next gamma trap I'm going to talk
Uh,
about. Yeah, retail traders may not necessarily be trading or hedging their positions, but if they are, it doesn't put them in a good spot with exclusively short gamma positions at their disposal. Plus, this lowered IV is added kerosene.
no, exactly. The IV to some extent helps you offset the risks and it widens your break even point. You have some cash extra to cover potential losses. But yes, if you start 10, 15, 20% or very, very lower than what you expect, then yes, it's very hard to manage for sure.
Yep. So what you were saying about um or what I was saying about market makers, this potentially being a stabilizing force for them as they hedge going into expiration of those DOVs. Sure, they might be long gammas with the DOVs, but as you can see by this chart, if you look at their net inventory, which is quantified by a metric called gamma exposure or GEX through a calendar year. This is for BTC through Amber data. Um, Most of the time it's in the negative. So what does this mean? Well, that means the market makers who are delta hedging pretty frequently have to buy into rallies, sell into downturns. So if the DOVs are a stabilizing force on the converse side for the market makers, it's not as much as they would hope buying these OTM calls and OTM puts. So and the contrast that needs to be drawn here is the fact that it's rarely ever this way in traditional markets, more traditional markets like equities. Their GEX, their net portfolio inventory is rarely negative, or else you get something akin to what we saw in GME several years ago.
So why is total gamma so negative? And I'm looking at some like
I
periods
think
like
part of it
July
is
2023. Yeah.
fragmentation for one, and just market makers. There just aren't as many electronic crypto options market making participants yet. So the liquidity just is being piecemealed together. We're just not as mature as other asset classes. So that plays a part as well. But it also reinforces the idea you're going to have these feedback loops.
Very cool. And to some extent, the view at Panoptic is that providing liquidity in Uniswap is like selling an option. So most Uniswap LPs are 100%
Yep.
negative, right?
Yep. Exactly.
And then the only way to reduce your gamma is with options, or could you do it with futures or some or perps? So how do
You
you?
can do it synthetically in other ways, but of course, the easiest way is through options.
Okay, and yeah, so the risk gamma risk is what I'm sure market makers have to worry about on Panoptic and buy options as well. But so it's as so they would be long options at least in TradFi for like
Equity, yeah,
continuously.
for like each options market maker in equities, they may have a basket of 100 names, 200 names. Odds are they're going to be flat at the end of the day, flat at the beginning of the day, but they're going to try to maintain, if they do hold their inventory for an extended period, they're going to try to be long gamma, or else you get what you got several years ago.
And then do you have say S&P or SPX or one of those large instrument as a one gamma hedge, or you also hedge within each instrument? And
That, I guess that depends on the market maker, but for SPX options in particular, you can find a figure just like this, and we'll have a figure in the article where it shows it's been negative twice over the span of 15 to 20 years, very episodic. So, and as you can see, this was negative for most of a calendar year.
Interesting, interesting. So, yeah, very cool. Good insights there. The Bitcoin slash crypto markets are still very very nascent and young, but yes, this is good.
Going into the next one, now this is a little more esoteric, but BTC and ETH options, their volatility surfaces can be characterized by what's called a sticky delta regime, meaning these are rules of thumb. They're sticky strike, sticky delta, sticky tree. And sticky delta describe basically characterizes a trending underlying spot movement, either to the upside or to the downside. And what sticky delta means essentially is, like, say you have a 30 delta call, and the underlying moves. So now there's a new price inserted for that 30 delta, but the implied volatility is the same. Depending, no matter how the price moves, the 30 delta implied vol is maintained. Um, so what that denotes is positive spot implied vol correlation. And as you can see here through 2021 going into 2022, pretty negative, but at the same time, um, there's a distinct line of demarcation going into 2023. So that positive spot implied vol to me is a definitive inflection point for the sticky delta regime taking hold. And how you hedge it is the same as you would in reverse gamma scalping, how you would hedge this skew, which is that you buy into rallies, sell into downturns. So that's a different viewpoint than just say gamma, it's through skew, but the machinations of a gamma trap are the same.
Interesting. And also for the concrete outcome or the concrete result of this is that for some reason 2023 seems to be an outlier, but what we see a lot in equity, in TradFi, and kind of in even ETFs and indices is that there's a negative correlation between spot price movement and IV.
Yes,
The floor is falling, the price goes down, the IV, the risk goes up, and that's kind of what we want to see, and that's how you react. If you already have the stomach for it, you can even be short delta in your portfolio, so that when the price goes down, you earn on the delta, but then lose on the IV, and it kind of correlates. But that's kind of the typical direction. Stocks go
yes,
down, IV goes up.
yeah.
In
In crypto,
2023,
vol up. Yeah. In crypto, more of the governing norm is BTC go up, vol go up.
yeah.
That may not quite recently, but 2023 through late 2024, this seemed to be more so the case.
And it just says that this might be more violent moves to the upside, or the big purchases of MicroStrategy, or someone perturbs the market in a way that is uh, not fear inducing but volatility inducing when the price goes up. So yeah, maybe same thing with even Deribit, having BTC be the unit of measure for some of those. You may have to kind of cover your positions in a
Yeah,
different
well,
way.
one part of it too is in these new regimes, there's what's called a skew delta. So there's a modified delta, not just conventional vanilla delta, and that's based. So when you have this positive spot vol correlation, um, the uh, the correction term or skew delta is deducted from the traditional delta. So say if you sell, if it's a put, you're going to have to sell more because your delta is going to be closer to -1. And if it's a call, you're going to have to buy more because you're going to be under hedged from the standpoint of your delta is going to be closer to zero than it should be,
Yeah, no,
if that
that's
makes sense.
yeah. Again, this is kind of advanced, but that's
Yes.
balancing the Greeks. Sometimes you have Vega on one side, you have your delta. You want your value to stay pretty much constant, so you have to hedge. But yes, in that specific case where there is a upside risk or positive correlation, you would trade differently than the S&P 500 ETF, for instance.
Yes. Yeah,
Very,
or
very
most
cool.
traditional assets. Yep.
Yeah, and it does go back and forth. It seems all very sudden too. So this is also, I remember when we first showed this to us, it's like not a dislocation, but it's positive until it's very negative, like we see maybe in
Yes.
August 2023. Uh, I don't know what happened then, but yeah.
Well, and often rapid changes in the spot vol correlation are a precursor to a spike in realized volatility as
Ooh.
well. So these are more common in commodities, and I consider crypto to be a subset of commodities, these rapid inflection points in spot vol.
And
But more traditional asset classes like equities, as you were saying, yeah, it's typically stock down, vol up.
and and then I like this fact about equity and commodities because they trade differently. And to some extent,
Yes.
if the barrel of oil changes in price, it's much scarier on the upside. Tells you
Mhm.
about some maybe
Yes, supply
international
disruptions.
crisis. And then that's why the this is also maybe a good example. Yeah, for sure. That now the risk is on the upside. Price going up of oil means that people are scared. You have your positive correlation type of thing. Very cool.
Yes, and that ties into one our last gamma trap actually. We're not there yet, but The next one is a negative Vanna gamma squeeze. And for those not familiar with Vanna, Vanna is a second order options Greek, also like gamma. It's a little more convoluted from the standpoint. It's the change in delta with respect to the implied volatility, or it can be the change in vega with respect to
The price.
changes in the underlying spot. So it's more of a spot vol Greek. And OTM call options have a positive Vanna, while OTM puts have a negative one. And this is another asymmetrical one. So say you're short an OTM call in crypto. Okay, with that positive spot vol correlation we were just talking about, now there's a dually depressing effect on your delta if you're short OTM call options. So that reinforces even more that you have to buy. Whereas because you're not only negative gamma, you're negative Vanna as well. Whereas with OTM puts, you're negative gamma if you sell, but you're positive Vanna. So that kind of truncates the downward spiral.
Very cool. Yeah,
And yeah. Oh, and I was just going to say credit to Jeff Park at Bitwise Investments for planning this one in my head.
oh, there we go.
Or,
The higher order
or
Greeks.
yeah,
the
or Bitwise Asset Management. Yeah.
Yeah, no, we should have him on too, I guess, on this show.
Yeah.
But this is definitely so. This is
Hopefully.
very advanced, but it's another one where the side that you're on, puts or call, it may seem like it's like not just the delta, but also the higher order Greeks make it so that you trade them
Mm,
differently.
yes.
We have IV, I guess, in a slightly different way in Panoptic, and I'm always kind of trying to see analogies because we do have delta, gamma, theta. The Vega is a bit harder to extract, Savannah as well,
Yes.
but that might be also a research topic. But like
Yes.
change in vol is buyers and buying activity directly impacting the theta and then the return. So that's also something that's a bit more market driven. You can imagine if the price goes down, people may be buying put options. This impacts both the IV but also the theta. But yeah, maybe we'll do a piece on Vana. So again, is
Mhm.
Vana your favorite one, or what's your favorite higher order Greek six
Favorite
sites?
Greek. Vanna and Volga are pretty important, I would say. But Vanna, there's Zalma, which is a third order Greek, but that's a different topic for a different time.
And
But
then
yeah,
what's
anything with
Volga,
spot vol.
maybe quickly?
Volga is the vol of vol.
Oh,
So
I like
that's
it.
the Vega with respect to implied volatility.
Yes, which is
So it's
again,
Vega convexity.
and
Yeah.
a lot of what we look at even in the trading show is the historical IV. We have the Volmex kind of Ethereum or Bitcoin index, but that price as well does have an IV in a way.
Yeah.
So that's pretty cool.
But our last one is based in the convenience yield. And since we were talking about commodities a few slides ago, convenience yield is a very important aspect of modeling commodity price dynamics. And basically, what it means is convenience yield can be modeled in traditional commodities markets like a call option with a stochastic strike price. And it's all predicated in the roll yield. So if you look at futures term structure, backwardation or contango, backwardation being a downward sloping, so futures as you get further down the curve are lower than the spot. Contango, it's the upsloping curve, so futures down the curve are higher than the spot. It's the yield you are allotted by owning the underlying physical asset and commodities markets in case of supply disruptions or stockouts. So the way it manifests itself, say it's a backwardated curve, so you're short inventory. Okay, that would mean that the futures have to converge to the spot at expiration, right? So the futures roll up. So
Mhm.
that's where it's a call option. You're converging to the upside. But in some markets where it's negative, um, if you own the underlying and say the futures term structures in contango, it rolls down at expiration. So owning the underlying is is like a owning a put option. In crypto, though, it's negative, but at the same because of the long-term contango, but there's also a different incentive structure. So you're more behooved to own derivatives rather than the underlying due to hacks or exchange closures, things of that nature. So, not to mention leverage chasing. So, when you own the futures instead of the spot and there's already a negative convenience yield, it's akin to shorting a put option.
Hmm.
So, it's an embedded put option not dissimilar from the Uniswap doom loop. And what you see in this chart is the basis, the way it's quantified here. Sometimes you see spot minus futures. This is futures minus spot.
Hmm.
As that grows and grows and grows, the futures premium, it's a precursor to incoming price risk. Usually you see the max and then it crashes down. Um, so really what this means is like as the negative convenience yield expands, it's more of like a downward move where you're selling a put option. So then eventually it capitulates, it crashes down, and you have to sell to make up for it. So once again, this is another asymmetrical one, not all that is dissimilar from the doom
And
loop.
also the contango backwardation futures term structure is very present and prevalent in commodities. In crypto, we have perps, right? But then the best way to
Mm,
think about this is if your funding rate is positive or negative, it's
positive.
still instantaneous. But some teams, maybe Athena, that are doing the basis trade, this is also maybe a cause for concern. If your short funding becomes positive, you can be in a similar, maybe dangerous situation to some of those.
Yes. So that's the final gamma trap. But to conclude, with all these crypto native feedback loops augmenting volatility, why not trade it on Panoptic? This is RIV for the last month in the USDC ETH 30 bips pool. And
Pretty
you can see
juicy.
how the IV broaches the 300 level twice. I checked the ETH vol, it barely touched 100. Now, granted, different quantifications, different computations, but there's no better way to trade these types of expanded volatility loops than on Panoptic.
Yeah. And I like these charts.
That's,
We show very concretely, and even one where we compare with Deribit, that Uniswap and Panoptic are still pretty early on in terms of liquidity and sophistication. There is a lot of opportunities because of that heightened IV, and that's one type of trade you can do. And that's kind of the only place you can do it sustainably. You can have a actually, yeah, it's very hard to trade the IV on anything else than options. Even if you want to create an index like the VIX, you still have to have options underlying it. So that's very,
yeah,
very cool. And one thing that I want to also point out is that on this chart, you see these super low downward spikes, right?
yeah.
There's a few, and again, they seem to be pretty low. Can you comment on that? What is this very, very short, very low IV
I
environment?
think you just see a higher vol with RIV. Granted, different computations, but you've heard of the VVIX, like the
Oh,
volatility of
yes.
volatility index. I would like to see ours if we made one of those compared to like a DVOL VVIX,
Interesting.
DV vol per se.
Yeah,
I would like to see that because I think you just see more instantaneous feedback reflected with movement in and out of pools, the way
yeah,
we compute our
and
implied volatility.
maybe
But
what
it's even more beneficial to own options, though.
exactly,
Buy or
and what I
sell.
would this is looking at the Uniswap IV, and maybe I think what I think is happening here is that these very, very low downward spikes, like this is actually just in time liquidity. There's a huge trade.
Ah,
Someone puts a lot of liquidity. They are actually selling an option for 12 seconds at a extremely low IV. It seems instead of being 100%, it's back to 5-10%. But it is what the market makers slash the those just in time liquidity provider are doing. But that's a different way. They are trading low IV for a short amount. They have a certainty to get paid because they control the block, that means they're okay with selling something at 15 IV when the block before, with all of that uncertainty, was 60, 100, or 200. So the way we also see just-in-time liquidity on Panoptic is that extremely short-term option. You dictate the terms in a way, and these just-in-time liquidity providers are okay with selling it at 10% IV, it seems, but it's still going to be like a trade. You have quantification, certainty of one block versus uncertainty of several months. That's kind of the trade off there.
Yep,
But
absolutely. That's a good insight.
yeah, very, very cool. So I think that's it for your presentation, right?
Yes.
Okay, very cool. So yeah, thanks a lot, Nathan. So this is again the seven magnificent seven demo traps of crypto.
Mm,
Uh, love your content. This is actually very, very cool. A lot of what we see is the gamma is kind of this flywheel, or kind of maybe chain reaction type of effect. It can be
mm.
scary, and then again we see several places where it's said, but that's kind
Well,
of
it's an
the
old adage, Vega wounds, but Gamma kills.
yeah.
So that's where, yeah, a lot of my interests lie.
There we go. How people get killed, and then the the one solution is to go long gamma, so you have the upside and positive feedback. But this is also another risk management, and definitely not something that the it's not free money either. There's always risk somewhere. So this is pretty cool. Yeah, thanks a lot, Nathan. So we again a bit over 30 minutes, but overall this was great. This is the research bite with the research team, Panoptic research team, beyond the creeks. We went beyond Gamma and touch upon Vanna and Volga. This is cool. But yeah, any last word before we adjourn?
No, just feel free to, not really, just feel free to hit me up on Twitter if you have any further questions. Always keen to talk Gamma and higher order Greeks in general. So, Jeff Park, once again, open invitation.
Of course, yes. No, definitely. All right. Thanks,